Good morning.
Morning.
Yesterday we did introduce on finance sources, okay, and I think the last thing we were discussing was on the convertible bonds, okay, and the convertible bonds, okay, they give the holder the option of converting the bonds into equity share. So the holder, maybe in future, okay, you may want to consider, okay, among should I convert or should I continue holding on to the bond, okay. So therefore, there we that is a trade-off, okay, in short, okay, whether you're going to convert the bond or whether you'll be continuing with the bond, okay. That is, in case you convert, that means therefore you become therefore an equity shareholder, okay. Otherwise, you remain being a debt holder, okay, and of course you have therefore all the rights that pertains to you as a debt holder. If you convert, therefore you become a shareholder, and all the rights that pertains to being a shareholder, okay, and you have all the rights that pertains to being a shareholder, okay, including voting, okay. So it's an option that you have as a convertible bond holder, okay. Therefore, the question is, okay, what therefore will be guiding you, okay, when it comes to make the decision as to whether to convert or not convert, okay? Of course, don't forget, we assume that you are a rational investor, okay? You're what we call a wealth-driven investor, okay? So therefore, the option or the alternative that give you more value, give you more wealth, could become therefore what you'll be taking, okay? So therefore, you take the option or the alternative that grants you more value, more wealth, okay? Therefore, you'll be comparing, if I convert the bond, what do I be receiving? If I hold on to the bond, what do I be receiving? Okay. Don't forget, as a holder, this is an option you have, not an obligation. Okay. This is an option you have, not an obligation. So as a debt holder, as a convertible bond holder, okay, you weigh the alternative. Okay. As mentioned, okay, you're going to take the alternative that results you getting more value. Okay. So therefore, you have to determine what alternative therefore should I take. Okay, so it's going to be driven purely based on which of the alternative will give you more value. Okay, so let's do that. You see, what alternative gives you more value. Okay, if you are a bond holder, okay, if you are a bond holder, you'll be getting the redemption value. Okay, don't forget what the redemption value is simply the what you agreed at the point of the issue, at the point of the bond issue, okay, you must have agreed upon the price you'll be receiving at the point of redemption. Okay, so it is going to be contained in the bond covenant. So you agree that, hey, in year 2030, this bond has a life of 10 years. Therefore, in year 2030, you as the company, you as the issuer, okay, you'll be paying us for every one bond, for example, you'll be paying us $110 per bond. Okay, so you agree upon in advance. The redemption value is therefore contained in the bond covenant. Okay, so since this bond has the option of conversion, okay, since this bond has the option of conversion, okay, therefore now be making a comparison. The redemption value and the conversion value. Conversion value, okay, let me just share my. So you be making a comparison between the redemption value and the conversion value, okay? And of course, since you are wealth driven, you take the alternative, or you'll be advising, or you will take the alternative that gives you more value, that gives you more value for sure, okay? Sure, yeah. So therefore, we make a comparison between redemption value and the conversion value. Let me just delete this. Okay, so the holder, you'll be making a comparison whether to convert within the bond. So you'll be comparing the redemption value, and as I mentioned, the redemption value, this is going to be contained within the bond covenant. So you agree that as per the bond covenant, at the point of redemption, okay, for every one bond, you'll be paying us, for example, an agreed upon price. Let's say, for example, $110 per bond. Okay, the redemption value is contained in the bond covenant, in the bond agreement. Then you have the option of conversion. This bond is convertible, not just redeemable, it's convertible. Therefore, you make a comparison. What is the conversion value? And the conversion value is simply equal to the market value of the equity share you'll be receiving. Okay, the market value of the shares you get in the equity share you'll be receiving. Okay. So, for example, you'll be getting, let's say, the number of shares per bond as per the covenant is, you agree that in year 2030, you can convert your bond into, let's say, 15 equity share. Okay, Therefore, it will be equal to what's the value, the market value of these 15 shares you'll be getting in year 2030. Okay, if for example the share price in year 2030 will be, let's say, $8, therefore the amount to be received therefore be 15 times 8. Okay, to give therefore guess 120. Okay, you get 120. Then you make a comparison. Okay, if I convert the bond, this is the value you'll be getting. Okay, you'll be getting share worth 120. If you redeem the bond, you'll be getting 110. Then make a decision. Should I redeem or should I convert the bond? Okay. Therefore, it makes more sense for you therefore to convert the bond because you get more wealth, okay, as opposed to you redeeming the bond. Okay. You make therefore a decision. Okay, should I convert or should I continue hold on to the bond? If you continue, you get 110. Okay, if you convert, you get shares worth 120. If you convert the bond, why? Because the conversion value, the shares we get have a higher value than if you're to redeem the bond. You get 120 as opposed to 110. Clear? Okay. The conversion value, as I mentioned here, is equal to the number of shares you get per bond is equal to the number of shares per bond, 15 times the share price at the time of conversion. Therefore, it's giving us the conversion value, conversion ratio. The conversion ratio is simply the share you get for this 15. Okay, refer to them as the conversion ratio times the share price at the time of conversion. Okay, share price, which is in the share price conversion time at the time of conversion. That gives therefore the conversion value, okay, which is 15 times 8. Okay, 15 times 8. Okay, simple as that. Now, when it comes to valuation, okay, when it comes to valuation of the bonds, okay, we notice that, okay, as per the theory, the fundamental theory of valuation, fundamental theory of valuation, we notice that the market value of a financial instrument, the market value of an instrument is simply market value, the market value of a security of a financial instrument, okay, the sum of present value of all future receipts, okay, for the future receipts, okay, that the holder or the investor would get, okay. That's generally what fundamental theory of valuation. The market value of security is some present value of all the future receipts that you're receiving. So in case we have to apply this theory, okay, towards the bond, what do you get? Okay, you'll be getting the interest. Okay, so in case the bond is, let's say, the case of if the bond is redeemable, what do you get? You get the interest. Okay, therefore the market value of the bond, therefore be equal to the present value of the interest be getting, the present value of the interest be getting over the life of the bond. In the final year, don't forget this bond is redeemable. So therefore, what do you get? You get the redemption value, okay, which I think you have mentioned here. You get the redemption value. Don't forget this bond is simply redeemable, not convertible. It's simply redeemable. Therefore, the market value of the bond, therefore, the receipt be getting in form of interest plus the present value of redemption value. That's therefore give therefore the market value of the bonds. Okay, simply put, therefore P naught, the market value, be equal to, okay, the interest be getting after tax, definitely if there's tax, times present value and it factor. Don't forget you get the interest every year. This is a bond, it pays you every year, therefore is an annuity. The amount the interest you'll be getting is fixed, therefore is an annuity. Okay, n years, where n is number of years to redemption. Okay, we discount them at R%, which in this case is the cost of the debt. Okay, in the final year, you redeem the bond, redemption value, we discount back to year 0. N years R%. Okay, where P naught, okay, is equal to the market value of the bond. What else? INT is equal to net interest receipt, net interest expense or receipt, whatever you want to call it, net interest, interest, cash flow or receipt. Okay, R is the cost of debt. What else? N is number of years redemption. number of years, on the number of periods. Okay, that's better. Number of years to redemption. Okay, better put the number of periods to redemption. What else? RV is equal to redemption value. Okay, so that's on this bond. Okay, that's again the market value of the bond. Okay, now the question here is that what if the bond is convertible? Okay, what if the bond is convertible? You say that as a holder, you have to make an evaluation. Okay, where do you get more value? Where do you get more wealth? Okay, therefore, in the final year, you have to compare redemption value and the conversion value. Okay, which means therefore, if the bond is convertible, okay, if the bond is convertible, its market value P naught will be equal to the interest we're getting, the net interest we're getting. Okay, if there's tax, you get the tax times present value and factor n years R% plus the final year. You can either redeem the bond or convert. So we're making a comparison between redemption and conversion. Where do you get more value? Where do you get more wealth? Okay, times the present value and interest factor, because you only convert once or redeem once, so it's not an annuity. Present value interest factor n years R%. Okay, we are now here n. Okay, we CV, just this what we don't know, is a conversion value. Okay, the conversion value for the one you have just determined above. Okay, here, this conversion value. Where is this? Yes, okay, here it is. This conversion value. Okay, clear? Brian, it's clear?
Kindly go through the convertible bond formula again.
Okay, simply in the convertible bond formula, don't forget this bond it pays you interest. Okay, therefore you be getting the interest. Okay, every year until the time of conversion or redemption. Okay, whichever comes first. Okay, therefore here we get the sum of present value of the interest receipt we getting per year. Okay, discount them back to year zero. Look at the annuity, they are fixed amount, therefore they are an annuity. In the final year, you have the option of either converting or redeeming. Okay, and as you have mentioned previously, if for example we say that what is going to be driving you is among the two alternatives, okay, between conversion and redemption. Okay, if I redeem, this is what I'll be getting. If I convert, this is what I'll be getting. Where did you have you had it somewhere? I think I've rubbed off. It was 15 times 8, which was giving us $120. Okay, therefore here there's more to be earned if you convert at 120 as opposed to redemption. Therefore, what do you do as a holder? Convert the bond. If it was vice versa, you assume, for example, here it was, let's say 6. Okay, this therefore give us therefore 90. Okay, so therefore if the conversion value, okay, if the share price 20 years 10 years from now, time of conversion is equal to 6, the value of share we'll be getting is equal to therefore $90. Therefore compare, if I convert I'll be getting 90, if I redeem I'll get 110. What do? You redeem the bond, because here there's more wealth compared to the conversion. Therefore don't forget you're wealth driven, so you take the alternative or the option that result you getting more value. Okay, so here therefore in the final year you compare conversion and redemption. Where do I get more value? Okay, you take therefore you'll be taking therefore the option that grants you more wealth. Clear?
Yes, thanks.
Okay, simple as that. Let's therefore get therefore the market value of yes.
What do you mean by redemption? Could you please explain that again?
So redemption, let me just go back. Redemption, you agree with at the point of the issue of the bond. Okay, assume that the company want to issue the bond today. Okay, so they go to the market. They tell you that we as a company, Safaricom, we as KBLC, okay, we as Vodacom, okay, we are going to issue a bond today. Okay, give us our $100 per bond. Then in year 2030, 10 years from now, we are going to repay you back. Okay, and shall give you $110. So this is agreed upon today. Okay, therefore this is called the redemption value. So the price at which you agreed, you as a bondholder and the company issuing the bond. Okay, what will be the amount to be received per bond is called the redemption value. So this is contained in the bond covenant, the agreement that you signed with the company, the issuer, that is. Clear?
Yes, thank you.
Okay, so therefore, don't forget this, you refer back to the covenant, the agreement the company has with the issuing company. Okay. Okay, and that's therefore simply determine therefore the market value of the bond. Maybe what if the bond is don't forget, what if the bond is irredeemable? Because you can have a case where the bond is irredeemable. Okay, so this bond was redeemable, this bond was convertible. What if the bond is irredeemable? Okay, how therefore do we get therefore the market value? If the bond is irredeemable, what that means therefore is that it does have an end life. Therefore, simply its market value is the market value P naught to be equal to the present value of the interest received from today to infinity. Okay, from today to infinity. Okay, so since this interest is also fixed, okay, if you still remember, we see that in case we want to get the present value of a cash flow to infinity, the present value of the cash flow is equal to the amount or the annuity we divide by R. Okay, we divide by the discount rate. Okay, we mean therefore you can apply the same concept here. Okay, this interest is fixed; it is being paid to infinity. Okay, therefore the market value P naught or the sum of present value of the interest, therefore with the interest to be received 1 minus T in case it's tax, we divide by R. And simply therefore you do get therefore the market value of the bond if it is irredeemable. It is going to be paying the interest to infinity. There's no end life. Okay, to infinity. That's the market value therefore of a bond if it was to be irredeemable. Don't forget, if it is irredeemable, there's no redemption. That's what the term redeemable means. There's no redemption. There's no any payment of back of the initial capital that the investors did invest. Okay. Clear? Any question? Okay, no question. Great. So go through this question, then we tend to it together. Together. So here you have a bond here which has a life of 5 years. Okay, therefore N is 5 years, so N is equal to 5 years. The cost of debt is equal to R. The cost, the discount rate is 8%. We've been told that it can be converted into 40 shares. Therefore, conversion value, which they'll be converted in how many years time? 5 years time, is conversion ratio times the share price in year 5. Okay, let's call this P5, share price in year 5. You get 40 shares. Okay, you've been told that the share price, part A, the share price in 5 years time is $2. Therefore, a conversion value of $80, or simply the total market value of the share we be getting in year 5 is equal to 80. We compare that to the redemption. Redemption, we told that it can be redeemed at a premium of 5%, premium from the par value. Okay, therefore, it will be premium is therefore 105% times par value of 100. Therefore, I'm getting $105. We compare. If I convert, I get 80. If I redeem, I get 105. What do you do? Of course, you redeem the bond. Okay, therefore. Therefore, redeem the bond. Since the redemption value is greater than conversion value. Okay. Therefore, the market value of this bond, therefore P naught will be equal to the interest we get in, the interest in case it's tax, you less the tax, okay, times present value added factor, okay, 5 years, 8%, okay, plus the redemption value is 105, therefore 105 times present value interest factor, 5 years, 8%. Therefore, how much interest we get? The board is paying an interest at a rate of, it is paying at a rate of 25%. Is there tax? There's no tax here, therefore, then interest to be received, therefore, is net of tax, therefore, be equal to 11% times the par value of 100. Therefore, every year for the next 5 years, every year be getting $11. Therefore, the market value P naught will be equal to $11 times present value added factor, 5 years, 8%. You redeem the bond and getting 105 times present value interest factor. This you only redeem once. Okay, therefore it's a single cash flow. 5 years, 8%. Therefore, to get to the market value of this bond, as part A, you get how much?
105.
105. Okay.
Sorry, 115.
105. 115.
Yeah.
Okay, 115. Therefore, for the market value of the bond, if it was to be redeemed, or in case the conversion value is not worthwhile. Okay. Then what if the bond, as part B, I mean, as what if now the share price in year 5, that is as part B, year 5 was the share price. The share price is $3. Okay. In that case, therefore, the conversion value will be equal to the number of shares you get per bond, 40, times the share price then, that is 5 years from now, and therefore give therefore 120. You compare conversion value and redemption value, which is 105. Therefore, this case, therefore, you convert the bond. There's more wealth here than this case. Okay, therefore, convert the bond. Since the conversion value is greater than redemption value, okay, therefore the market value of the bond P naught, therefore be equal to the interest we getting, which remain as they remain the same, $11. Present value added factor, number of years is 5 years, remain as it is, 8%. However, in the final year, we are going to be converting. What do you get? You get 120. We discount, therefore, back to a 0. Okay, 5 years, 8%. And you get how much?
$126.
Don't sound off.
So it's 125.643.
64. Okay, yeah, 5.64 will have to be the market value of the bond in case the share price in 5 years' time will be $3. Clear, Sakina?
Yes.
Sakina, are you in class? It's clear.
Yes.
Okay, great. Okay, it is clear. Let's go to examiner. We see some of the questions that your examiner has asked in the past. Okay. Okay, I think page 1 there's a question there. Yes, it is, I guess. Yes, page 1, company called Forbes Company. Page 1, question 1. So go through it. We discuss part B. Forbes Company, page 1, question 1. Okay, suppose that you have gone through the question. So in this example, you want to get the company, the market value of the bond, the floor value of the bond, and the conversion premium. Okay, so the market value of the bond, therefore you have to compare redemption value and the conversion value. Redemption value between that it can redeem at par, therefore redemption value is a par value of 100. Conversion value, this bond can be converted into how many shares? 20 shares, and it will be converted. The number of years conversion is equal to in 5 years time, n is equal to 5. Okay, and then you'll be told that the current share price is 4.5, therefore it's 4.45. However, the share price will be growing by 6.5%, therefore 6.5% for the next 5 years, because we want to get the value of the share price 5 years from now, therefore to the power of 5. Okay, so this is the current share price. The 4.45 is the current share price. What about the share price 5 years from now? It is growing by 6.5% per year. Okay, the power of 5, therefore. Therefore, what becomes of the conversion value?
$122.
You get therefore 122. Okay, you get 122. This is not enough, done. Okay, therefore you compare. If you redeem, you get 100. If you convert, you get 122. Therefore, what do you do? You convert. Okay, convert the bonds. Since the conversion value is greater than redemption value, therefore P naught, therefore will be equal to the market value. You first need to get the interest before you can get the market value. How much interest we getting per annum? Okay, net of tax in case there's tax. There's tax here. I'm not sure. Is there tax here? There's no tax here, therefore, okay, you get an interest at 9%, interest 9% times the par value of 100, you get therefore $9 because of the interest we're getting per year. Therefore, market value P naught will be equal to the interest we're getting times present variant factor, number of years conversion, discount of the company cost of debt, plus the conversion value or redemption value, present value interest factor, okay, for any years percent. The interest we're getting is equal to 9, okay, times present value added factor. Number of years is 5. The cost of debt, which is R here, is equal to 10%. Conversion value is 122. Present value interest factor. Number of years, 5 years, 7%. And you get how much?
Sir, how is interest 9%?
9% over 100. It is paid at 9%, isn't it? Or daily 12. Yeah, the company has issued 9% bond. Nafisa, can you see that? The first line.
Okay, thank you.
Okay, great. Therefore, what do you get?
$124.
123.87.
886.
89, okay, to 3.89 for the market value of the bond, okay, if the conversion value will be at 122, okay. Okay, fair enough. That's therefore the market value of this bond. Then you're being asked to get the floor value. Okay, now in the floor value, we are told here is like we are being told assume there's no conversion. Okay, like we are made to assume there is no conversion. Okay, what would be the market value of this bond? Okay, there's no conversion. If there's no conversion, the market value of this bond would be equal to, okay, P not to be equal to the interest we get in, okay, times present value and factor, N years R%, okay, plus there's no conversion, therefore simply redemption, time present value interest factor, N years R%, okay. If the market value of the bond would be the interest 9, present value factor, 5 years 7%. The conversion, the redemption value is 100 times present value interest factor, 5 years 7%. 7%. You get how much?
108.2.
108.2. Okay. But in case this bond was not it was not convertible, its market value would be 108.2. What we call the floor value of the bond. Okay. Then we ask about the conversion premium. The conversion premium.
Sir?
Yes, yes.
So for the floor value, it's
Mm.
always the redemption value.
No, we are assuming. Okay, we assume that what if this bond was not be converted? So definitely this will be there for redemption value.
Okay, if it's a redeemable bond, it is the floor value will be the redemption value.
No, if it's a bond that is redeemable, then it has no floor value.
Sorry,
don't forget the floor value applies to a bond that is convertible. So the floor value doesn't apply to a bond that is redeemable as per se. Okay. So don't forget the floor value applies to a bond that is convertible. Okay. What would be the market value of this convertible bond if it was not, if there's no conversion option? If is an if situation. So therefore there's no floor value for a bond that's simply redeemable, not convertible. Zakina. Sakina, you don't understand that question, Sakina. You are the one. Okay, that was clear. Therefore, that's on the floor value. Okay, so the conversion premium. Okay, let me just repeat. If a bond does not have the conversion option, then there's no floor value. You don't need to get the floor value. It has no floor value. Okay, so the floor value applies in case the bond is convertible, like in this case here. Conversion premium would be equal to what? In case you convert the bond today, how much of your wealth will you be losing? Okay, this is the lost wealth. If conversion occurs, let me just put it. This is the lost wealth. Okay, if conversion occurs today, if conversion, okay, or take place today, occurs today, it'll be equal to. Don't forget, if you convert, it means you're going to give up the bond, then you get the shares. Okay. The current market value of the bond is 123.89. Therefore, this is your current wealth, 123.89. What if you convert today? If you convert today, okay, what will you be getting? You'll be getting how many shares? 40 shares. At what price? 4.45. Okay, they're 40 shares. They're 20 shares, sorry. They're 20 shares. Okay, therefore, the value of the share you'll be getting today, in case you can opt to convert today, this is what you'll be getting. But don't forget your wealth is 103.89, the total market value of the bond. So in case you convert, how much will you be losing? How much will you be losing? 34 point? I don't know, I'm just guessing.
$34.89.
Yeah, therefore that 4.89 for the conversion premium. The amount of wealth you'll be losing. What if you be gaining? It because of a conversion discount. If it's a gain, okay? Because we refer to it as conversion discount. The premium, it means you're losing. Okay, in case you opt to convert this bond today. Clear?
Sorry, sir.
Mm-hmm.
I lost you. when you were answering my question.
Okay, so I wanted to ask you whether you had understood the concept of floor value.
Not really. I lost my internet connection was bad.
Okay. So we are saying that the floor value is simply the value of the convertible bond if it was to be redeemed. If the conversion option is not worthwhile, it's an if situation. Okay, so therefore the floor value only applies to a convertible bond, not a bond that is redeemable. That's what I was trying to mention.
Okay.
Yes. Okay. So the floor value only applies to a bond that is convertible, not a bond that is simply redeemable. It has no conversion option. So here we are just assuming. Okay. We are assuming that there is no conversion option. Okay. So here in the final year, in the final year, therefore, here is simply have the redemption value, not conversion, but simply redemption. So you simply treat this like a bond that is like redeemable, but not a bond that's redeemable, like redeemable. Is this clear?
Yeah.
Okay, great. If we get that 4.8 times
Thank
therefore,
you.
sorry?
Thank you.
No, you're welcome. Now, there's a question which I want you to try in the next, okay, it's a very easy one. So I would want you to first try on conversion. So let me look for it. As I mentioned, don't forget, in case it is to be a gain, okay, if you convert, then that's a conversion discount, okay? Okay, this is another. Okay, let's do this together. So this is this question, page 55, page 55, a company called Per Company. Page 55, per company. We do part A. Page 55, per company.
So what page?
Page 55, 56. Okay, suppose you've gone through it. So you want to get the market value of this particular bond. Okay, so suppose that you have at least made the attempt on your side. So you see that here the market value of the convertible bonds comments whether conversion is likely. Okay, so the bond can be converted. It can be converted into 8 shares in 7 years' time. Therefore, N is 7 years. Okay, then the conversion value is the number of shares you get per bond is 8 share. If not converted, can be redeemed to the same date at their nominal value. Redemption value is 100. Okay, therefore, what's the conversion value? Is 8. We multiply the share price of 7 years from now. The current share price, how much? Okay, not going to us, but I think we can work backward. Is it going to us? It is going to us. The share price as at year 2014 is 10.9. Okay, therefore, current share price 10.9. The share price 3 years ago was 9.15. Therefore, we can get the growth in share price. We'll be equal to the current share price 2014. Share price 2011, 3 years ago, the power of third minus 1. Yeah, therefore, 10.9 divided by 9.15 to the power of a third minus 1. What the share price? What the growth of the share price? The G. What do you get? We did quickly.
So growth in percentage, or?
Yes, in percentage.
6.007.
So 6% more or less. Okay, 6% because of the growth in the share price. Therefore, the current share price, which is 2014, is 10.9. And then 7 years later, it will be equal to the growth is 6%. Therefore, 1 plus 1.06 okay, to the power of 7. Therefore, this give the share price. This gives the share price 7 years from now. Okay, we are simply forecasting what will therefore will be the share price 7 years from now. Okay, therefore, what counts as the conversion value?
$131.
Don't round off on that 1.12
12.
on that 1.12. Okay, therefore the conversion value equal than one that 1.12. We make a comparison: conversion value, redemption value. Therefore, we convert. Okay, convert the bond. No, you meant to make the comment. The examiner here has told you very explicitly: convert the bond, since the conversion value is greater than redemption value. Okay. The market value of the bond, P naught, to be equal to the interest we get in, the interest, if there's tax, you less the tax, times present value and factor, N years percent, plus conversion value or redemption value, whichever is greater, present value interest factor, okay, N years percent. Therefore, the interest we get in, if you hold of this bond, you get 8%. Is there tax here? There's no tax rate here. Okay, fair enough. Therefore, the interest we're getting, okay, without tax will be equal to 8% times the par value, which is 100. Then every year, therefore, you get therefore $8. Therefore, market value is $8 times present value earned factor. 7 years. The cost of debt you've been told is equal to how much? 9%. 9% plus. We see that to convert the bond, since the conversion value is greater, and we get one that's 1.12 times present value interest factor. 7 years, 9%. What do you get?
One 111.99.
1.99. That's it.
Yeah.
1.99. Okay, because therefore the market value of this bond. Okay. Let's do the last question. There's one question which I think would be good for us. Let's see if I can get it, which I would want you to first make the attempt. Hey, it's not here. Convertible. Let me see if this convertible. Okay, can you do number 11? Do number 11. This is page 26. Page 26, number 11. 114.8887.
87.
88. Okay. That's the conversion value. Okay. Then if you have to redeem, what do you get? They can be redeemed at their nominal value of 100. Therefore, definitely convert the bond. Therefore, the market value P naught will be the interest. This bond is paying at the interest at a rate of 3%. Is there tax? There is tax at 30%. However, you have to check on the cost of the debt. The cost of debt here is ignoring tax because this is before tax cost of debt. Therefore, we also ignore the tax. Therefore, the interest to be earned. Therefore, interest to be earned, ignoring tax. Okay, therefore, be equal to 3% times the power value of 100. Therefore, $3. Therefore, market value P naught. Sorry. Market value P naught, therefore, be equal to P naught. Let me just drag a bit. The market value because the interest 3 times present value and factor 5 years. The cost of debt is 10%. Redemption value is how much? Conversion value is 114.88. Okay, times present value interest factor 5 years 10%. 10%, yes, 10%. And you get how much?
$82.71.
It's 2.71. It's 2.71 for the market value of the bond. Okay, great. Any question?
Sir, what
Yes.
if tax was included?
Sorry?
What if tax was included?
What do you mean by included?
As in, if it was not before tax cost, like
Or even
after
after
tax.
tax?
Yes.
So in case here the cost was after tax, so in case the year was after tax cost of debt, then therefore we need to include the tax here. The interest here would be net of tax. Okay, there will be, for example, times 0.7 to give therefore 2.1. Yes, it will be net of tax also here. Clear?
Yes, thank you.
Okay, great. There's another question that asks us to actually do that. Let me see if I can get it. This. That's really. Yeah, back to page question 1. No, this is not what I wanted. There's another question that asks us of more or less the same thing. Let's see if I can get it. You're meant to get the cost of debt. Sorry, no, you're meant to get the market value. Let me see. Almost a similar question. It's an ABC question, the same way. Section B, section A type of question. I think it was more section A. Okay, that should be this one. Sorry, my word is not working. Not sure what's happening here. Microsoft Word. Not sure. Okay. Not sure what's happening here. Let me just close off this. Okay, I think I have it there. So there's a question. Yeah. Okay. You can get it. Yes, I think that's the question. Yes. Yes, this is page 52, question 9. Page 52, question 9. You can see the number of the time to conversion is different, so therefore it's in quotes slightly a bit tricky. Okay, because in case you out convert, then you convert in year 7. If you have to redeem, you redeem in year 8. Therefore, what happened? Therefore, in this case, let me present this through Excel. Okay. Okay, so in this example, where is this? Yes, okay. So we can determine, let me just zoom this. Okay, so let's take the option of redemption. Okay, redemption, that means if we get a redemption value equal to the par value, I guess, yes, of 1,000, okay, in year 7. So in year, yes, in year 8, get in year 8, okay. Which implies, therefore, the person who convert, okay, will losing the redemption value and the interest for year 8, okay. Therefore, the cash flow, the cash flow we see with the person will redeem, the extra cash flow in quote, so the person will be redeeming equal to the redemption value equal to 1,000 plus the interest for year 8. Don't get you convert in year 7. Therefore, you lose the interest and you lose the redemption value. Therefore, 1,000 plus the interest received. Okay, the board is paying 7%. Okay, therefore 7%. Okay, 7% of 1,000. Okay, to get therefore 1070. Therefore, the person who going to do the redemption will be getting a cash flow of 1070 at the end of year 8. Therefore, the value of that cash flow today, that does not start today, and years before, which is year 7. So let me go PV at year 7. Okay, year 7 or year 7 will be equal to this is at year 8 and year later. So it is counted back to year 0, and the cost of the debt for this bond, which is 8%. Therefore, the value of the cash received in year 8 as at year 7 is 990.74. Clear, Brian?
Yes.
So
Okay. Sorry?
could you please repeat the present value at year 7?
So this is year 8. The cash we get in year 8 is 1070. The value a year before, which is year 7, you simply discount by 1 year, isn't it? So 1070 discount by 1 year. $1070 divided by 1.08. That's clear, Sakina
Thank you.
and Afisa.
Yeah.
Okay, great. 90.74. Then compare. Sorry.
I didn't understand how you got 1070.
1070. Okay. In
Yeah.
year, what cash would you? What's the redemption value?
1000.
How much interest do you earn per year?
Interest.
7%.
Yeah, 7%.
Or 1,000 to give us 70, isn't it?
Yeah.
10% of 1,000 to give us 70. Therefore, the total cash flow to be received in year 8 is equal to 1,000 plus the 70. Clear? Clear? Is it clear or not?
Why did you add 70?
Because in year 8, what do you get? What cash flow do you get? In year 8, you get the interest
1000.
and the redemption value. Because don't forget, this bond is paying interest every year for the next 8 years. Therefore, in year
Yeah,
8,
but here it says that it's redeemable at the nominal value of 1000.
Of 1,000, yes, I agree, 1,000. But on top of that, you also get the interest, don't you?
Yeah, we do.
Yes, so that's 1,000 plus the interest, you get 1070. That's only year 8. This is only year 8 cash flow.
Okay.
You seem not so convinced. Don't forget, this bond is paying interest every end of the year. Year 1, year 2, year 3, year 4, year 5, all the way to year 8. Then at the end of year 8 also, you redeem, you get 1,000. Therefore, in year 8, you get 1,000 plus the interest, which is 1070.
Okay.
Is it clear?
Yeah. Kind
Then
of. Yeah.
Yes, then since this is cash flow for year 8, okay, then you discount by 1 year, which is now to year 7. You discount it by 1 year. Therefore, 1070 discount by 1 year to get at year 7, we get 990.74.
So we discount it because
So
the
that you can compare
convertible loan notes are
as at year 7.
convertible after 7 years. That's
yes, so that now you can have a fair comparison.
Okay. Yeah, now I get it. Yeah.
Okay, great. Conversion of value, which is this is at year 7, is equal to the number of shares you get per bond is equal to 110 share. Therefore, 110 shares. We multiply by the share price. Then 7 years from now, the current share price is 6.5. Okay, it is growing at a rate of, the growth is equal to 4% as per number 1, 0.4 to the power of 7. Okay, you have the conversion value. Then you compare, should you convert or redeem? Definitely redemption give you 990, conversion 940. Therefore, redeem the bond. Okay, redeem the bond. Okay, the bond. Since the conversion value, okay, is less than redemption value. There's the market value of the bond, therefore, will be equal to, can have here, 1, year 2, year 3, year 4, 5, 6, 7, 8. You can call 7 or 8. Let me just call 7, or even 8 if you want to. So here, cash flow will be as follow. Every year you get 70, so it will be 70 every year, all the way until year 8. Then on top of it, in year 8, you also get another. You also get 1,000. So therefore, this is 1070 as at year 8. NPV, simply get the NPV, or simply get the market value, MV, which is NPV. NPV, we discount the company cost of capital, the cost of debt, 8%, 0.8, year 1 all the way to year 8. And again, therefore, 942.53 therefore to be the market value of the notes. Clear? Okay. Now, if now the growth is 6%, that will be equal to conversion value will be equal to as at year 7. Yes, yes.
Is this the alternate way of using the formula?
Alternative way of using the formula. It's the same thing. That it's only that I've done through Excel. But the same thing. What I've done, I've just sorry.
Is it the same thing?
Yes, the same thing. Yes, the same thing. You can also do the P naught is equal. It's the same thing. Only that now I've used Excel. It's the same thing. P naught is equal to interest, present value factor, plus redemption value back to. It's the same thing I've done here. Only I've done through the Excel. It's the same concept. That's what you asked.
Yeah.
Where has my work gone? I don't know where my Excel has gone. I have no idea where it has gone. Okay, we will get it. If we don't, no problem. And I've lost my work. So anyway, so we had got 942. Okay, so option 2 was to where we got the conversion value. Okay, conversion value in case the growth is equal to 8%, 6% will be equal to the number of shares you get remain at 110. Okay, times the share price is 6.5. Okay, 6.5. They are growing at a rate of 1.06. That's the power of 7. Now the conversion is occurring year 7, not year 8, and you get 1045. The redemption value, okay, as at year 7, was equal to 990 point something. It was 990 point. It was 990 point something. Okay, what we had just done together there. Okay, it was. I think I can do that quickly. 1070 divided by 1.74. Okay. Then now we can compare. Don't forget there has to be this is now as year 7. This is year 7. They're both at year 7. This is year 7. Year 7. This is also at year 7. Okay, now you can make a comparison. Which one do you do? You convert the bond. Convert the bond since the conversion value is greater than redemption value. Okay. Yeah, the market value of the bond, therefore, I'll have here year. You can have cash flow. Okay, year 1 all the way to year 8. Year 7 now. Was you're converting year 7. 4, 5, 6, 7. Cash flow $70 every year for the next 7 years. However, in the final year, you also be getting the conversion value, therefore, plus conversion value 1075. Therefore, year 7, that's going to have the market value. Therefore, market value of the bonds, therefore, be equal to NPV. First, the rate, I need to define the rate here. The rate is it 8%? What is the rate here? Is 8%.08. And I get 991.75 because of the market value of the bond if it was to be converted as year 7 and receive $1045.1 to be the conversion value. Clear?
Sir,
Yes.
I didn't understand how we get the present value for year 7, the 990.
Present value of redemption value and the interest.
Sorry?
Don't forget this 990. You're asking how you got 990.4.
Yeah.
Don't forget in year 8, what cash flow do you get?
1070.
You get 1070, isn't it?
Yeah.
That's clear. That's clear. You get 1070. That's clear on your side.
Yeah. I understand how you get 1070.
Okay, then if that's okay, then it's really easy. So year 8 here, okay, we have a cash flow of 1070. We want to discount it back to year 7. By how many years? Only 1 year. Therefore, the only discount, this definitely be discounted 1.08. Isn't it?
Oh,
Because,
okay.
because we want to get the value, it's not a present value per se, but we want to discount it, okay, by 1 year, from year 8, year 7, from year 8 to year 7.
Okay, I get it. Okay.
It's clear.
Thank you.
Okay. Any other question? Okay, no question. Fair enough. Then we can make therefore at 2:15. We pick from there. Okay, then see you at 2:15.